Hello, everyone. I hope it's not too early for you after all those parties we had yesterday. So I'm Mounir, founder of ParaSwap. I would like to talk to you today about the future of liquidity, decentralized aggregation. Sorry. And ParaSwap, we are a liquidity aggregator on the Ethereum blockchain and other side chains as well. I would like to start by defining layers in DeFi and Web3 in general. So we have the first layer. If we ignore the infrastructure layer, that is the blockchain itself, we have what you call the assets layer, which are like ETH and ERC20 tokens. And to use those tokens for buying, selling, for lending and borrowing and so on, we have what we call the capital aggregators. And those are either decentralized exchanges, lending protocols, and so on. And to put that in the hands of end users, whether those are like people or the protocols themselves, or dApps and wallets and trading bots and so on, we have what you call the service aggregators. And those are either UIs like an Argent, Zerion, Zapper, and so on, or it can be other services like ParaSwap, for instance. There is an API that will allow other dApps and wallets, or maybe even other protocols like an Aave, for instance, to access or manipulate those tokens. So that's the service aggregators layer. What is an aggregator? And here we're talking more about the aggregation theory, and it has three characteristics. Well, first, aggregators have direct relationships with users, and that's something that came especially from Web 2.0 companies or like technologies. For instance, we don't need anyone to access Google or Facebook or any Web 2.0, as we don't need anyone to access any Web 3.0 company. We just go to the website, so it's served through the internet. There is zero marginal cost. There is zero marginal cost. Yeah, better. Zero marginal cost for serving users. The content is served on the internet, so it doesn't cost more to serve a user in Portugal than someone in Australia. It's exactly the same cost, and that's also something that is related to internet and Web 2.0 companies, which is not the case, for instance, in e-commerce. Like in Amazon has a marginal cost for serving end users, which is something we don't have in web in general, whether 2.0 or 3.0. And the last thing is what we call this demand-driven multi-sided network with decreasing acquisition costs. It's a bit too long to say to talk about network effects, which means that at a certain critical mass, user acquisition becomes, like, the cost of user acquisition becomes decreasing. An example will be a social network like Facebook. At some point where we reach a critical mass in a number of users, where users have their friends and their friends bring other friends and so on, the growth becomes organic and natural. So it does cost less for the platform or the aggregator to acquire more users. And that's something also we can see in DeFi, like for instance, take Uniswap. In the beginning, Uniswap needed liquidity providers to have traders, and at some point, and after reaching a critical mass, the growth becomes organic because every party is served. The liquidity providers, they have the fees that are their main incentive, and the traders who need to swap or exchange value, they have sufficient liquidity and sufficient market depth. We can classify aggregators in different levels. And here we try to map some of the DeFi protocols and see how they fit or if they fit in the first place. So the first level is what you call supply acquisition. Those are terms brought by a guy called Ben Thompson that he's making a lot of research on the aggregation theory. So that means that the platform or the aggregator owns the supply side. An example would be Netflix. Netflix owns the movies and produces the movies. So it comes at a very high cost. But the thing is, by producing quality movies, and they bring sufficient mass of users, which are gonna finance Netflix, which are gonna allow them to bring new movies or also to produce higher quality movies, and it becomes a virtuous cycle. An example I was thinking about yesterday is Olympus with the Ohm, where we are introducing a new DeFi 2.0, whatever buzzword recently, where it's no longer about doing liquidity mining programs, but it's more about issuing bonds and selling the token at a discount in the future in exchange for KPIs or performance KPIs, which means here the DAO owns the supply. And but it comes at a cost because we are selling the tokens at a discount. So I think, I'm not sure 100%, but it seems to me that Olympus Ohm or like whatever DeFi 2.0 looks a little bit like this supply acquisition level 1 aggregators. Then on a level 2, we have what you call supply transaction costs, which are aggregators that don't own the supply, but the supply comes at a cost. And an example will be Uber, where they don't own the driver, but there is a high cost of an onboarding. And maybe whatever liquidity mining programs where the protocols don't own the supply because it is still coming from liquidity providers. And these guys are incentivized by those liquidity mining programs, those farming programs, and this can be significantly costly for the protocol, for better or for worse. It depends on how it's managed, of course. And the level 3 is what you call zero supply costs, which means there is no ownership of no supply, no demand, and no users. And it's here we're talking about social networks typically, where the growth is purely organic and the aggregator themselves just need to provide the best possible products, and the critical mass will be reached as the platform grows. And here is the typical Web 3.0 dApps or DeFi dApps like Uniswap, Aave, Balancer, and others. In aggregation theory, we talk also about super aggregators who are like level 3, but they have a third party, which we call advertisers. And those are the customers in this case, because those are the guys who are paying the platform. So that platform will bring supply and demand and build this network effect. But who's going to pay for that aggregator? Well, in case of Facebook and Google and all the GAFA, well, those are the advertisers who are the main source of revenue. I tried also to find, is there a Web 3.0 or a DeFi protocol that has this property? And the only thing I thought about is flash loans for DeFi protocols like Aave, for instance. And it's not the main revenue, so it doesn't really look the same. But it's interesting because if we have sufficient network effects in Aave with lenders and borrowers, we can make sufficient, like, higher flash loans. So the higher, the bigger Aave, the bigger the amount of flash loans we can take. The use case, or the initial use case of flash loans is not really about whatever we know about flash loans. It's about like protection against liquidations and stuff like that, but it's used in other use cases and it's being monetized. There is a fee that is taken from flash loans. Whether this will evolve in the future or not, but that's the only parallel I saw in DeFi. To talk about aggregation quickly in financial markets, it exists in multiple forms. You can think Revolut, eToro, and others. But also in what I would like to highlight here is those what you call aggregators, or what we can call them like technical aggregators, which are SORs. And those look a lot like what we do on ParaSwap. They will execute trade on multiple exchanges and try to maximize the price and reduce slippage and maximize the market depth. The thing is here is that to use those software, we cannot use them directly. So it defies the first property of aggregators, which is this direct relationship with users. You have to be a broker, and I want to use a SOR, I have to go through a broker. And as a user, I don't even know if there is a SOR. Those are things that are highly technical in the financial markets or like traditional finance. It exists also in CeFi in multiple forms. So here's like users, so you can call Coinbase or Celsius as an aggregator as well. But also those are those aggregators that look like TradeFi, like SFox, Tagomi, and others, who allow this what you call best execution or SORs. The thing is, anyone can access those tools. Just need to do like some onboarding, but it's not close to a certain category of brokers. Anyone can have access to those tools. But in DeFi, I mean, we can have also the same thing, but it's just like a web browser away from accessing our process. In ParaSwap, in any other aggregator, we can just like go to a website or plug in the API, and we can do some very complex transactions and maximizing the price in a very optimal way without needing any intermediaries. So I would say that ParaSwap.io, Zapper Exchange, Zapper UI, or Zerion are aggregators. But the question is, how do we compare to DeFi with CeFi? What are the differences? CeFi still has the advantage of giving more options, which are, for instance, I can exchange BTC with Ripple, with whatever, which is not possible today. In DeFi, like real BTC, not a synthetic version of it. But the thing is, with CeFi aggregators, or like what we technically today call aggregators, is that there is no deterministic way of making a full transaction as we do it in DeFi. For instance, I have BTC, I sell BTC to USDT. The thing is, if this is executed in Binance, in Coinbase, if the trade fails on Binance, there is no way or no deterministic way to revert that transaction and get the first amount that I have spent, and especially if when in very high volatile moments, like I sell BTC, I receive less USDT, I'm not okay with that, I want to revert, the market moved on the other direction, I mean, I have less BTC than I started with in the first place, which is not the case in DeFi, but in the same blockchain. So I have WBTC, I'm saying to USDT, the EVM guarantees me that I will get whatever amount I'm expecting, or I have a cryptographic guarantee that this transaction will revert. But in the same thing would arguably apply to layer 2s, as long as there is a smart contract platform that runs on-chain that executes the trades, and that's the case for all EVM chains, even non-EVM chains, even other blockchains like a Solana, for instance, but maybe not the case in some hybrid layer 2s like a Starkware, for instance, where everything happens off-chain and only the settlements happens on-chain, which are like set of proofs that are pushed on-chain. So a Starkware system looks a lot like CeFi, and that's something we can see in DYDX, for instance. So now the question is, what about cross-chain? Well, cross-chain, they bring more capabilities. So things start to look like CeFi or even TradeFi, but now we are breaking composability. And by breaking composability, we are breaking atomicity. So that problem we had with CeFi aggregators will now be happening also in cross-chain platforms. So we are having the same challenges in like CeFi and TradeFi, and the same techniques of risk management, obviously these guys have thought about those issues, will apply here, and I think they will apply in a better way because the innovation is very interesting, but I think also this becomes much more complex. The challenge is to deliver the same security level without sacrificing decentralization. And I think this is happening also already. So now the question, knowing all of that, the question is, will what we currently call aggregators, are they really aggregators? And if they are, will they stay aggregators? My thinking, I don't think so, because if you take, for instance, ParaSwap, everyone calls like DEX aggregators, but in my opinion, those are infrastructure products. The aggregator side is the UI, like ParaSwap.io or Uniswap.exchange. This is an aggregator with those three properties we saw before. But the product itself, or the protocol, is a pure infrastructure product, and I think there will be a separation between UIs that are like check all the marks for aggregators, and those are UIs of any protocol or any protocols, or also the UIs of Argent, Zerion, Zapper, which will be representing DeFi to end users at the end of the game, and maybe DEX aggregators will become much more complex with multiple components, one that's making aggregation on a single blockchain and others that's making aggregation on different blockchains, and those, in my opinion, will be pure infrastructure products. So that's all I had. Thanks a lot for your attention, and happy to answer any questions.